all the money is in turbines. You want to power that through a pipeline, through a natural gas power. I love that everybody is suddenly now interested in energy. All right, let's get right now our all-star Fed panel. Set you up not just for today's decision, but also the markets and meetings ahead in January, March, and April. Very pleased, as always, to be joined here in studio. David Kelly of J.P. Morgan Chase, Francis Donald of RBC Capital Markets, Jim Karen of Morgan Stanley joining us remote. Jim, welcome as well. Francis, I'll start with you. Your expectations for today.
They're going to cut, but I got to tell you, today is not about this Fed decision for me. It's about what it continues to reflect about an incredibly complicated economy. We have very limited data visibility. We know that employment is softer, inflation is rising, the economy is fragmented into that K-shape we all know about now, and let's not forget, we have a once-in-100-year trade shock. How is the Fed going to explain all of this to us, and how are they going to set us up for 2026 in an economy that is decreasingly interest rate sensitive and yet still has its firm eyes on what Powell or Powell's predecessor does next?
Would you consider David Kelly today to be what they would say is a hawkish cut, but with cautious language?
It's kind of like when parents give a kid, okay, you can have one more cookie, but this is the last cookie.
And it never works until the next one.
No, well, exactly. But I think there's going to be it's going to be a cut. We could get multiple dissents here, and I think they're going to really push it out and say, don't expect another near-term cut.
Jim, I don't want to look too far ahead of today because it does matter. 90% chance of a Fed rate cut today. Looking at the CME Fed Watch tool, you got about a 25% chance in the market of a rate cut at the January 28 meeting, first one of next year. Where do you land on the next possible cut?
So on the next possible cut, it's going to be all dependent on what happens in the labor market. The labor market is really the key messaging for the Fed. The Fed has to be careful, though, right? It doesn't want to walk into a policy mistake by being either too hawkish or too dovish. Because the path of least resistance right now is towards higher bond yields, which is not necessarily effective or a good thing for markets. So if the labor data continues to weaken, if it softens further, then I think January is very much on the table. If it doesn't, then we're going to kick the can down the road.
Yeah, we're going to find out here in about 15 seconds. Like we said, it is a mixed trade. You got the NASDAQ slightly down, the Dow slightly higher, the 10-year yield right around 4.16%. Let's go now to Steve Leisman on the Fed's decision on interest rates. Steve.
The Federal Reserve reducing interest rates by an expected quarter point to a new range of 3.5 to 3.75. There were 3 dissents. The first time that's happened since September 2019. 2 were against the cut, including Chicago Fed President Austin Goolsbee, along with Kansas City Fed President Jeff Smith, his second dissent in a row. Also another dissent for a 50 basis point cut from new Fed governor on loan from the administration, Stephen Myron. To recap, the vote was 9 for cutting a quarter, 2 against cutting, 1 for cutting 50 basis points. The Fed signaled a higher bar for the next cut, using language that it's used in the past to do so, saying that it will assess incoming data to determine the extent and timing of future rate moves. That language it used it last December to signal a pause. The rate outlook suggests consensus for just 1 more cut next year and 1 more in 2027. But as I'll get to when I talk about the dot plot, a lot of disagreement. Before the dot plot, though, I want to talk about some pretty big news when it comes to the balance sheet. The committee making a determination, it is now at what it calls an ample level of reserves. So it plans to initiate purchases of shorter-term treasuries on an ongoing basis. And then a separate document was specific, saying the Fed will begin buying $40 billion in bills starting December 12th. That's just a couple days from now. And I believe that's sooner than the market expected. And those purchases will go on for a little while at an elevated level because of seasonal demands for reserves that are out there before coming down again in April. That's what the document says. Outlook on the economy in the statement. GDP outlook was stronger next year in the Fed's own forecast, up 0.5 point to 2.4%. So pretty big move there in the outlook for GDP next year. The inflation outlook lower for next year by just a tick, down to 2.5%, just about hitting the target of 2.1 in 2027. The statement says the economy is expanding at a moderate pace. Job gains have slowed and unemployment has edged up. Just a note, the statement no longer says that the unemployment rate is low at the current rate. Inflation is seen as somewhat elevated, economic uncertainty also elevated. Back to the Fed outlook and the dot plot real quickly here. Only 2 dissents, but 6 officials in total wanted no change in the funds rate according to the dot plot. So kind of a soft descent in that regard, you can call it. 7 want no change at all for next year. 11 only want one cut next year. One person, and we can imagine who that is, Stephen Myron, just guessing here, wants rates down to 2.12% next year, or 150 basis points lower. And that is the statement and the outlook for rate cuts and the balance sheet. Mr. Sullivan.
Quickly, sir, you said buying bills maybe sooner than the market expected. This is not QE. I do not dare call it that. But is this like the son of QE, quantitative easing light?
You know, Brian, people are going to take off on this, and I don't want to stop the craziness that'll happen in social media and on the interweb. The Fed will say this is maintenance of its balance sheet at a level of GDP of where it was. Some people, however, will call it QE light. Some people will call it son of QE. I believe the Fed will say this is neither, that this is simply maintaining the balance sheet at what they call the ample level of reserves, and that will cause them or prompt them to begin buying $40 billion of bills. It looks like 3 years. They also may go out a little bit into the bond market as well, but they want to stick to the short end of $40 billion a month until about April, when they say there'll be a sharp decline in there. And Brian, call it what you will.
Let's see what Rick Santelli calls it. Steve, stay right there as you continue to dig through this. The market reaction initially showed a very dovish tilt. We have stocks moving to session highs. We have bond yields falling. Rick, your interpretation?
Well, my interpretation, Steve nailed it. I don't disagree with social media going hog wild. They could put any spin on it they want. Ample reserves to deal with the reverse repo market issues, but it is QE, call it QE light. And once again, I have an issue with this, and my issue is simple. Every crisis, they expand the balance sheet by buying securities to manage rates or manipulate rates. Pick any M word you want. But in the end, this is something to really pay attention to. And finally, the markets themselves, we saw a couple of basis point drop pretty much across the whole curve. 358 down to 356 in a 2-year. 10s were hovering right around that 416 level. They dropped about 2 basis points to 13 and change. They're right back to 415. What's notable is where we were this morning, as Brian pointed out, the fact that we're toying with 420. Remember, we closed at 457 last year. We're getting ever close to unchanged on the year. On a year that many analysts and experts thought we'd be spending a boatload of time under 4%. We've had a total of 8 sessions close under 4% so far in 2025. The dollar index, no surprise there. It's down about 1/3 cent. It was down about 1/4 cent before the statement was read. It's definitely toying with this 98 3/4 to 99 level. It seems to have lost its hunt for 100 recently, but that makes sense considering the Fed's easing. And finally, the next meeting, January. Many are talking about the January 28th meeting. For a while today, we had about a 30% probability of a 1/4 point ease. That's now moved to around 24%. It's been bouncing around a bit. If you look at the March 18th meeting, that's also hovering around a 25% probability of a 1/4 point cut. But basically, the real issue for 2026 is how much the market's going to pull out on the easing mentality as we continue to get data that certainly doesn't look like the labor market is dying a quick death. And in terms of inflation, not a lot's changed in the last 16 months. It's sticky, and it doesn't seem to be coming down closer to the Fed's target.
Rick, appreciate it, and we'll circle back in a moment. But let's get more from Mike Santoli. Mike, on what jumps out to you about the market's reaction here and what the Fed just told us?
Yeah, sort of net.
What is going on, guys? I'm going to give my take on the Fed decision, which was basically a 25 basis point cut. As I said, I think that was priced in. What I don't think is priced in is what Jerome Powell is going to say. So right now, I wanted to see whether we take data low or data high first. It looks like we took data high, so that's the 2 p.m. high there. And as we know, the FOMC day is typically there are multiple manipulative moves because there's the initial announcement where we see this manipulation up. Then there's Jerome Powell coming on the mic, and then we get what happens after Jerome Powell says what he says and answers questions. So a lot of times we get 3 moves within FOMC. Obviously, looking at an intraday chart, the 25 basis point cut is as priced in as it gets. I don't think that was really a question. It was a question for a little bit when the government was shut down and we didn't have any government data. We saw the 25 basis point cut go from 90% down to 30%, back to 90%. But it was due to the fact that we didn't have any data, which means that the Fed was flying blind. But I think the 25 point cut is priced in here. So I want to see from a trading perspective whether there is a move here to be made before Jerome Powell starts talking in 22 minutes. Right now, there's a little bit of divergence here between NQ and ES, and both of them took data highs. So I wonder if there is actually a short here to get down to data low before before Jerome starts talking. Uh, 708. But today, honestly, has just been a scalper's paradise. Except for this big move that we see here after the Fed rate has been announced. I haven't taken a large trade or a broad trade today. We're going to get Jerome Powell in 20 minutes. And we still have that divergence between NQ and ES.
And I would really say that this is ironic, right? And I think we have to see the irony in this. The Fed has basically raised the bar for the next rate cut, right? So we still think they're going to cut, but it's going to be a higher hurdle for them to do that. However, they did surprise the market on the dovish side by moving that balance sheet management from what many people thought was going to be early next year to actually what's going to happen starting, right now here in December.
Gold took Asia high. I wonder if there's a gold trade here. I wonder if there's a gold short here. I'll talk about some individual stocks in a second, but we still have that bearish divergence between NQ and ES. Do we sweep that one more time? I wonder if we take the weekly high on gold. That high right there. I still think there's a potential short coming. We already took the weekly high on ES and left it behind on NQ. So I think there still might be a short here. Jerome Powell's in 13 minutes. Consolidated, PO3, back down to data low. I want to see if there's a gold short, not right here, but maybe if we inverse this, back down to data low. Same as NQ. Yeah, let's see if gold inverses that. Let's see how this plays out here. Jerome Powell comes up in 10 minutes. So it's definitely risky trying to trade this here, but I think it's a decent setup with a fantastic risk reward. If it starts making a move before he talks, I'll likely set it to break even or take profit. So that's 1-to-1. Nice move here. Let's see if we get follow through. We got Jerome in 7 minutes. If we inverse that gap right there, then I think we go to Shitsville. Shitsville being that. Yay! Let's go. Two to one's that. So I may start trailing my stop at 2 to 1. Beautiful. Can we get down to data low before retracing? Sometimes people think this stream is stopped because I don't move while in a trade. Nice. Up 1100 here. Keep going. Keep going. Take it. Obviously, don't follow me. Take it if you want. What trades are you in? The one that's right in front of you. All I want is for Jerome Powell to say, good afternoon, and then it drops. Good afternoon, and then it drops. But then his name wouldn't be Jerome Powell, it'd be Jerome Patel. $1,200. Okay, we got 2 to 1 here. Let's not be retarded. I'm going to start trailing my stop here. Using the 1 minute. Dumbass. That was too slow. Oh, well. Oh, well. What? My copier gave me an error. What the fuck?
All right, welcome back to Power Lunch.
All right, guys. Hopefully you booked a nice little $1,200 per contract on NQ. I'm a little worried. My copier Tradeovate gave me a little error there. I have to restart my Parallels machine. I did take it in Thinkorswim too, though. So at least we have that. Beautiful. like a 2.2 to 1 trade. We don't even have to watch Jerome Powell. This fool said I just gave him rent money. Hell yeah. How many of you guys took that trade? I want to see W's in the chat. Throw the W's in the chat. Yay! Someone said I paid the rent. The other person said I made $1,300. Car payments. This idiot says hella gamblers. If you think that was a gamble, bro, just sign off the stream. Go watch someone playing slots on Kick or something. Honestly. What was your entry? Just rewind it, dude. I'm on a business trip. You paid my fucking drunk in Birmingham? Yeah, you do sound drunk. Thanks, Z. I'm going to buy a Nintendo Switch too. Damn, bro. We even got 12-year-olds trading in the chat.
Again, minutes away.
Available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators
The gold trade printed too, guys.
Expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September. In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending.
What an exit on that trade. Holy shit.
Energy categories' core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 0.75 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through. The adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy. In light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets.
Wait, they're basically doing quantitative easing, though.
Management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible. To conclude, the Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
I want to hear questions about the QE.
Thank you. Howard Schneider with Reuters. Considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
That was a
If I could
short.
follow up on the outlook there. It seems like with the additional GDP growth,
I think this now goes to that low right there, the 2 p.m. low.
here, what's given rise to that? Is this an early bet on?
I should have taken another short up here after we rallied. If you could see when Jerome started talking, we spiked into that 4-hour fair value gap up here. I should have taken that short. Oh, well.
It's partly that consumer spending has held up. It's been resilient, and to another degree, it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year. You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Steve.
Thank you, Mr. Chairman, for taking our questions here. You had previously described rate cuts in terms of a risk management framework, and kind of following up on what Howard was asking, is the risk management phase of rate cuts?
Ethereum looks, as I said in my video from Sunday, if you guys watched the Ethereum looks more bullish than Bitcoin. It actually confirmed the market structure shift. Part of the reason that BMNR is up quite a bit today, and I think this is the bottom on BMNR. I think if we get, everyone's going to try to focus on today's price action. But I think the effects of the FOMC, if they are positive, you're not going to see them till Friday, potentially next week. And if we get a crypto rally, then I think BMNR is going to be probably the biggest winner of that. It is pretty impressive that right now, at least the initial reaction, crypto, which is seen as risk on, Ethereum is up and Bitcoin is flat. But I'm going to take it with a grain of salt until price action starts normalizing within the next couple of days. And we want to hear the full extent of Powell's talks. Man, that gold short was too fucking easy. Should have taken both of them.
SCP, you have a whole lot of a big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now. So if you start thinking of it as 2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of time. So it's basically a good thing. But that's certainly the implication.
I would short this again, but we do have bullish divergence here.
Today's decision was clearly very divided. It wasn't just the two official dissents against the cut, but there were also soft dissents from 4 others. And I'm just wondering if this...
I still think it's a decent risk-reward short, but I don't like that bullish divergence. I want to see if I could take this short here. Because we haven't hit that 2 p.m. low yet.
What's going on, and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're gonna look at that really carefully and understand that it may be distorted by very technical factors.
And just one more question on dissents. I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions. And you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick Timmeros of the Wall Street Journal. Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down? Or should we think of policy risks as genuinely two-sided from here?
That's a great question.
I think that a rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year, but when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation. And as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation. But we're going to start to see the data, and it'll tell us whether we were right or not.
I want to see if ES or NQ, one of them takes the high and the other one doesn't.
It's Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. You know, in terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic, heat. You know, do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
Just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets?
All right. So looking at some individual stocks here, I said this to the group yesterday, but if we close above this little gap here, this volume imbalance on Tesla, then I think it goes to 500 pretty quickly. So that's what I'm looking at now from a stock perspective. And then if you watch the video from Sunday, we had a long on Hood. Took profits on that, but I think if we get close above that 139 level, then I think Hood will have a potential path to all-time highs. Meta looks interesting to me here as well after filling this gap. I think there's a potential swing long on Meta from here now. Netflix, I don't think there's a trade on just yet. I do think, if you buy it for the long term, it's getting to be relatively undervalued here. As I said, when it was trading at 100, that it was fair value, but it's starting to get to relatively undervalued area here. But I would not take a trade on Netflix. For me, I would just buy the shares. But I do like Meta here. All right, so we don't have any bearish divergence just yet. And to be honest, I don't think I would look for, I know I shorted NQ earlier. I don't think I'll look for another short here. I think that ES is going now clearly for December high. So that's the monthly high on ES. I don't know if NQ gets there today. That may leave some bearish divergence, but I would not short this just yet. You know what? I want to look at something here real quick. What?
Hinder your current job right now or change your thinking at all?
No.
No mulligans for it. Michael McKee from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepened.
Yeah, I think I might take this meta trade here. Not a day trade. This would be a swing trade. Oh. What do you know? We do have bearish divergence here, but I still think ES wants to go. Does it want to go for that December high? Let's see if we can get another trade out of here. I don't know. I'm not honestly like based on the move here. So the rate cut announcement, we had the drop. That's the one we shorted. Then Jerome starts talking. Then we have a drop. And then this rally here. We've already manipulated multiple times. And at some point, there is a prevailing move. And I think this is it. It coincided with Jerome saying that raising rates is not in anybody's wheelhouse. When they asked him, if there's a chance that the Fed may raise rates instead of cut rates. So I think that NQ is going possibly for this daily fair value gap, and ES is going for a December high. I don't think it's a good idea after so many moves have been made. And we caught one of the manipulative moves. I don't think it's a good idea to short here. As I said, down here, we did have bullish divergence. Now, I was hoping that at least NQ would take out 2 p.m., but we didn't get that. That right there is December high. So from a swing perspective, I think Meta's on the table. What does gold look like? I don't know if I take another trade here. We did pretty well. Would have liked to take that second short down, to be honest. There is a chance that we retrace back down a little bit. I don't think it tanks, but we retrace back down a little bit after ES takes December high and NQ touches the daily fair value gap. But, you know, if we retrace down, it'll be into some like previous imbalance or something. I don't think we tank all the way down. But yeah, I think the market was expecting Jerome to be hawkish, but he basically said when Nick Temeros, when Nick Temeros asked him, you know, could there be a rate hike? And he's like, I don't think anyone thinks that. And then plus the QE is something that we didn't know, right? I still want to read the details of what the QE is. I heard him say something like 40, did he say 40 million? I'll have to look at it. I'm going to do a video on it anyway, but. And then I'm going to wait until the end of the day. And if you're in the Discord, I might send out the meta details for the swing. Yeah, we are now sitting on the 21 EMA as well. What can you tell us about your story? How you started trading? Just watch a podcast if you're interested in that. I did a podcast with Words of Wisdom. So watch that. I'm not going to tell you my story here. APLD question mark. Ooh, we're up 30% on those Tesla calls. Hell yeah. Hell yeah. I'm likely going to hold these Tesla calls now that FOMC is out of the way. I think that Tesla's going to have a big December, especially if we close above this gap. I think 500 comes quick. This shit is still coiling. But we need Nebius to break above this, and then it will likely be violent. BM&R, holy shit. Oh, yeah. We hit 30%, 31% on these Tesla calls. The Tesla calls, I had sent those out 2 days ago, December 8th. And BM&R, that if BM&R can retrace, which if crypto takes off, good luck. But if we retrace, that's a long as well. So ES is like a tick shy of tagging December high. All right, guys. I think that's it on the day trading front. Made you guys a little bit of money. And we had a little bit of fun. All right, guys. I'll catch you on the next one. I'm going to do a video update on the Fed and what happened today. I want to go through what their asset purchases entail, but I appreciate you guys. Peace.